Hi everyone, welcome to another episode of the Mizuho Week Ahead. I am Xing Yi, market economist at Mizuho Bank. The theme for the upcoming week is Panic, Pause, but no Panacea. Last week, equity markets swung wildly between panic to exuberant relief and then back again. Initially, this was driven by worries of sweeping reciprocal tariffs, with the threat of further escalation. But acute market pain triggered what may be deemed a Trump put by way of a stay order on the additional component of reciprocal tariffs, whilst the baseline 10% remains in place. But relief was shallow and fleeting, as the 90-day reprieve elsewhere was arguably more than offset in a blowout in US-China trade antagonism. By the end of the week, US had ratcheted tariffs on China up to 145%, while China imposed 125% tariffs on US imports, alongside a suite of non-tariff measures. China further said it would disregard any further increases in tariffs on US goods, as it would be economically meaningless. While over the weekend, the US administration provided tariff exemptions for certain Chinese goods, including semiconductors, smartphones to flash drives. While this may be taken as a pause to escalating trade tensions, trouble is, this pause is far from a panacea, even without US-China worries. Most worryingly, Washington and Beijing are not quite close enough to even meet at the negotiation table yet. We expect turmoil and turbulence to be par for the course, which relegates other macroeconomic data to second fiddle in the midst of potential explosive headlines. Worse, it accentuates the Fed's policy paralysis, in turn potentially exacerbating trade-offs for central banks in Asia. For now though, the sharp pullback in the dollar provides some breathing room. Last week, all RBNZ, RBI, and BSP cut their policy rates, with more cuts on the horizon. RBNZ saw scope to lower policy rates further, noting that global trade barriers create downside risks for growth outlook, in addition to weak domestic spending and investment. Meanwhile, inflation was consistent with meeting target. RBI's cut to 6% saw it characterizing its monetary policy stance as accommodative. More easing could be forthcoming, with RBI cutting India's FY 2026 inflation view to 4% from 4.2% on sharper than expected decline in food prices and easing global crude oil rates, as well as reducing GDP growth to 6.5% from 6.7%. Meanwhile, BSP said further cuts would come as it lowered its 2025 risk-adjusted inflation forecast from 3.5% in February to 2.3%, but nonetheless caveated that it will take a measured approach towards easing. More easing is expected this week. Already this morning, MAS reduced the slope of the senior currency band, citing weakening external outlook and negative output gap. MTI also reduced its 2025 GDP forecast 1 percentage point from 1 to 3% to 0.2%. Meanwhile, ECB is expected to ease policy as a conditional insurance cut on heightened growth risk, but the front-loaded cut could raise the bar for future cuts. BOK is expected to cut rates by 25 basis points on the need to support growth on the back of a weak export outlook. While FX volatility and a resurgence in property prices in Seoul remain concerns, we expect authorities to adopt other measures, such as direct intervention and macroprudential measures to tackle them. China's and Malaysia's Q1 GDP data are also due this week, but while both Q1 GDP prints are expected to be solid, they are unlikely to provide much comfort given that the magnitude of risk and the outlook overwhelms. For now, FX and equities directionality will likely be dictated by the swings in trade tensions. With that, we have come to the end of this episode. For more information on the key events for the upcoming week, please refer to our Week Ahead publication or contact your respective sales desks and RMs. And for regular notifications on our market outlook, please subscribe to our channel and hit the notification button. Thank you and bye-bye.